Hello everyone. It's wonderful to have you back on our channel. Have you ever wanted to explore the stock market but felt utterly lost? Perhaps you've watched the news about market crashes or others making millions seemingly overnight. It can all feel overwhelming and uncertain. Well, fear not. Today marks the start of your journey, as we transform from zero to hero. In this video, we won't just throw numbers at you. Instead, we'll uncover the ABC of the share market together. I will explain how the system operates, how to steer clear of pitfalls that can drain your hard-earned cash, and most crucially, the very first step you should take to begin growing your wealth. So, let's jump in. What is a share? Before making any purchase, it's essential to grasp what it truly is. At its core, a share represents ownership. Picture a popular sweet shop in your community. This shop is thriving, and the owner dreams of expansion. He plans to open 100 new branches nationwide. For this venture, he requires substantial funds. Now, he faces two choices: secure a bank loan and incur interest, or invite the public to join as partners. When he seeks public investment, he divides his business ownership into tiny portions known as shares. Buying a share means you're not just handing over money, you're acquiring a stake in that business. You become a co-owner. When a company does this for the first time, it's called an IPO, or initial public offering. These shares then change hands on platforms known as exchanges. In India, the two major exchanges are the NSE, National Stock Exchange, and the BSE, Bombay Stock Exchange. How does your money actually grow? So, why should you buy a share? The answer is simple: you want your money to grow. This happens through something called market capitalization. Market cap is merely the number of shares multiplied by the current share price. But what pushes the price higher? In the short term, prices fluctuate due to news, speculation, or emotions. However, over the long run, stock prices consistently align with a company's earnings. Imagine it like this: a person walks a dog. The person represents earnings, while the dog symbolizes stock price. The dog might get ahead or lag behind, but eventually, it must follow its owner. As a company's profits rise, the stock price will eventually climb too. Consider Hindustan Unilever, HUL. When negative news caused temporary price drops, many traders panicked and sold. Yet, because the company remained profitable and continued selling, the long-term stock trend kept climbing. The moral of the story? Focus on the company's fundamentals, not the fleeting market noise. A word of caution: the tip trap. Be wary of the tip culture, the Telegram and WhatsApp groups claiming to offer 100% proof of profits. These scams deploy a straightforward trick. A con artist sends a buy tip to 500,000 people and a sell tip to another 500,000. Regardless of market movements, he appears right to half the participants. He repeats this daily, gradually narrowing down the group until a few view him as a genius who has been accurate multiple times. These individuals often end up paying heavily for premium tips, only to lose everything. The harsh truth? If these gurus could accurately predict the market, they'd be billionaires, not selling tips for profit. Always be cautious of unverified advice. Trust your judgment. The mathematical trap of loss. One significant misstep beginners often take is failing to comprehend the math behind losing money. This is a crucial consideration. If you possess 100 rupees and lose 50%, you'll only have 50 rupees left. Many mistakenly believe that a 50% gain will bring them back to zero. This misconception is incorrect. If you possess 50 rupees and gain 50%, you'll end up with just 75 rupees. To return to your original 100 rupees, you'd actually need a 100% increase. It's easy to lose capital, the challenge lies in recovering it. This explains why the stock market transfers wealth from the hasty to the patient. If you're impulsive and take significant risks, the market will redistribute your funds to those willing to wait. Your first step: index investing. Don't gamble on hot tips or attempt picking one winner out of thousands. Chances are not in your favor. The most intelligent strategy for beginners is index investing. In India, you can invest in the Nifty 50 using an ETF or index mutual fund, tracking 50 of the country's strongest companies, like Reliance and HDFC, all at once. This approach is safer as it offers immediate diversification. If one company underperforms, the others can stabilize your investment. As long as India's economy flourishes, so does your investment. It's the best way to begin without requiring expert knowledge. Conclusion: owning a share signifies owning a fraction of a business. Remember that profits drive prices. To thrive, ignore fake tips, respect the mathematics of loss, and kickstart your journey with an index fund. Investing is a journey, not a quick fix. Stay disciplined, continue learning, and I'll catch you in the next video.